Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
All sorts of fun. It is hard to believe that it's the middle of June, however.
It's hot.
It is
in Indiana.
Warm in Indiana.
Yeah.
You know, for those of you that are listening in other places, I'm sure it's probably warm for you too. It's suddenly a little bit drier. We're actually having to water things again.
I know.
It's funny how things change. And little by little, volatility is picking up in the market again. You probably have heard the surprising news over the course of the week. I woke up Monday morning. General Electric CEO Jeffrey Immelt is out.
I didn't hear that.
GE is the oldest company inside of the Dow Jones Industrial Average. It's the only original company.
Wow.
And it was booted out for a while and brought back in. But it's the only original company that's there. And Immelt took over the helm in 2001. And you compare it to a couple other companies that have had that are in that same space, if you will. Integrated technology, power, those kind of what we would call industrial machines. And Immelt may have inherited the company at a really bad time in 2001, 9/11 hit, right? They had a loan portfolio and houses that got hit. They had a long-term care unit that got hit, right?
Wow.
So he may have inherited it the long place, but relative to a bunch of other companies that are in his space, they really, really performed poorly over the last 16 years. And, it's going to be interesting to see what happens with that. My point of bringing it up is we don't talk a lot about individual equities. We don't talk even a lot about investment philosophy on this show. We manage money internally. I have a CFA and a chartered market technician. We work together to build a portfolio, and then we run them as tax efficiently as we can based on where you need to go. But the ability to pick or not pick particular companies does have a huge impact on your overall return. And it's important to have that good fundamental analysis, but not get attached to something. The Jack Welch was the CEO before Jeffrey Immelt, and it was almost like Jack could do no wrong. People hated him, but the stock market loved him.
Loved him,
right?
yeah.
And I would have people who just refused to sell that stock when they first became families that we took care of. And fortunately, we don't own any of it today. I'm not sure tomorrow is a bad day, but we're not long or short it right now in either case or situation. It's just things do change, and as you said, Sherry, it is hard to keep up with those.
Yes.
My thing is just for you to understand that different companies function in different ways, and 16 years is too long to be emotionally attached to something. So think about it. Hey, we got a great show lined up for you today. Sherry and I'll take a break. You got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. 4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along.
Yeah.
You know, Sherry, I have not been known for most of my career to be one who have kind of taken it on the side and played by the rules, so to speak.
You think?
You know, there are just core beliefs that I have always had, and part of it might have been when I entered the industry. You know, I got in 2 weeks before the crash in '87. And so I got to watch it, and don't feel bad for me. People always go, "Oh, you poor guy." It's like, whoa. I had no money. I had no clients. Right?
Yeah.
So I got to watch how people behaved when you lose 23% of your money in a day.
Yeah.
Right. And the emotional pain on both professionals that were in the industry, but also I watched how people begin to change in their mentality of investing in retirement. And what I realized was that people had a very hard time getting money out. They knew how to put it into 401ks. They knew how to put it into 403bs, but they were really having a hard time getting it out. Now,
what do you mean by that?
Knowing how much they could take and feeling comfortable with that. Right?
So it wasn't about the tax part of that.
Not
it was
not at that point in time. Now you got to think back in the time machine, right? We're talking about 1987. So the IRA just turned 40 last year, and you could only put in about $2,000 a year back then.
Okay.
Today you can put in $6,500 if you're over 50 and you qualify. The Keogh Act, the 401ks, really didn't start until 1980. So most of the accounts in '87 that were in retirement accounts weren't that big. It didn't affect as many individuals as it did perhaps pension funds and things of that nature. But I would still see people with $80,000, $100,000 accounts and they didn't know how much money they could take out and feel comfortable with what was going on. And, so my career progressed in the early 90s. I went to the College for Financial Planning, graduated there, got my CFP, and really I left the investing to what I called the professionals.
At that point?
At that point in time. So we sent, I did financial planning, and I would sit down with you, and like so many people listening to this show, I would send off money to the mutual fund managers. That's not true. I would send off money to the indices, to the S&P 500 and things of that nature that were available until 1995. And in 1995, I came across things that were called unit investment trusts. And so I want to walk you through this. Anybody who's listened to this show for a long time knows that I have challenges with the mutual fund industry.
Right.
And
You're
I
pretty
want
upfront about
and I
that.
want to kind of walk you through that just a little bit of what happened inside of my career. And if you went back to 1998, and some of you will remember, we used to call them the Five Horsemen: Microsoft, Cisco, Dell, Intel, and MCI. And as I remind young people who don't even know what MCI was, Bernie Ebbers is still in prison, right? It was one of the largest scams ever in history. But the bottom line is, if you didn't own those five stocks, you missed a large part of the run-up of the market in the late 90s. And now, obviously, you avoided a tech wreck in 2000, but believe me, you missed a lot. And what happened was the average individual who owned a mutual fund owned 11 of them. And you ended up owning Microsoft essentially in 11 different places.
11 times.
Now, you may say, well, Joe, that was a one-off. That doesn't happen very much. Well, folks, the S&P 500 at the end of May has done okay this year. And it might surprise you to know that the about 1/3 of the total return of the S&P 500 so far this year has come from 5 companies.
Really?
Almost half of it has come from a total of 14. So if you're still flying around out there with a couple ways to look at this, right? You're still flying around out there with various mutual funds that have similar returns. I will tell you what, you own the same stuff
stocks
over and over and over. And this is very, very dangerous, right?
That's crazy.
So when I can sit down and I can prove to people that what you pay Fidelity with people that you don't know, and you can have full financial planning to have a registered investment advisor manage the money and do the other stuff. Why isn't that a conversation that you would really want to take serious? When we do that portfolio analysis, that's really some of the stuff we're looking for. So back in 1924, when mutual funds were created, right?
Yeah.
There was a great need for them, and I don't have time to go into that. Great need for them back in 1924. But there were essentially three things that were created. Unit investment trust, which were a bucket of stocks with no manager. Open-ended mutual funds, which is what almost everybody has in their 401k. I have exchange-traded funds in mine, but the open-ended mutual fund where you put money in, a manager manages the money. When you want your money out, it comes from the manager. And another one called a closed-end mutual fund. And there are times to buy closed-end funds. We do that periodically. That's where you put the money in. There is indeed a manager. We don't buy it because of the manager. We buy it because of inefficiencies in pricing. When markets have great volatility, people get very, very confused, not understanding how their investment instruments work. Anyhow, when Excel was created, right, in the early 80s, the rationale behind mutual funds really changed. The concept that Sherry and I should put our money together in one bucket for the efficiency of Wall Street really began to break down. And it doesn't make that much sense anymore. And so what was once a unit investment trust, which is what we used here at the Financial Enhancement Group, where we would buy it as money managers, right? So you'd get the best price that we possibly could get, evolved into exchange-traded funds. And today we have more exchange-traded funds than we actually have more indices than we have individual equities to go into the indices. So it can become very, very, very confusing. But the reason that we like them, the reason that we use them, are essentially a fourfold area, if you will. If you go in and think about it, one is the transparency. I can see exactly what it is I own, so that I make sure you don't have Microsoft in 11 different places.
Right.
There are no internal trading costs, which some experts say is more than the fee that you pay the money manager, right?
Okay.
It's going to depend on the fund that you're in. But the tax efficiency, and obviously in an IRA, that doesn't matter. But if it's a retail account, which you really ought to have, especially if you're a charitable giver, you need to be building money in a portfolio that's exposed to the taxman every year, because it gives you great options and opportunities in terms of your charitable gifting. But just to try to understand this a little bit, in 2006, only 40% of advisors recommended exchange-traded funds, right? It was 44% in 08, 79% in 14, 81% in 15, 83% in 16, and today it's 88%. So yeah, I was way early compared to the average person, but that's not abnormal for me in my life, if you want to know the truth. I started in the industry when I was 21, so I had a different perspective. There was no professor looking over me that said, "Hey, this is the way you build the house. This is the way you do the window."
Right.
I went back and got the education instead of starting in the beginning, right?
So nobody told you. You figured it out yourself.
Well, and if you don't fall into the traps of what people have always done, it's easier to look at it. So all I'm telling you, my friends, is 88% of the people in my shoes will tell you that exchange-traded funds are better for you than mutual funds. If you are in them and you have more than $50,000, I suggest you have a cup of coffee with us. Sit down. Let's look at what it is you really own, which direction you're going, and if you can use fees that you're already paying to have the rest of your financial life helped. To me, that just seems to make some sense, right?
Yeah.
Hey, you guys are listening to Consider This. I'm Joe Clark, along with Sherry Contos. We got more we're going to work on today, but I just wanted to really get that out. We're going to come back and obviously talk a little bit about taxation. Shoot me an email. Consider this at yourlifeafterwork.com. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. The show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
And Sherry has questions.
I do. I know. Yes. Maybe it's just me. It could be some listeners too. So I'm going to ask him. So I don't think it's obvious the difference between exchange traded funds and mutual funds, because don't you still have somebody buying the same stocks for you? I mean, isn't it the same process?
The extreme majority of the exchange traded market is based on an index. So it started off with the Dow Jones, actually started off with the S&P 500, what we call spiders.
Okay.
And then it was the NASDAQ 100.
Right.
And then it was the Dow Jones Industrial Average. So if you ever turn on CNBC and you see SPY go across, that is the that is the exchange traded fund for the S&P 500. So there is no manager that's inside of there.
So you're buying a group of stocks that are in that portfolio.
I already know exactly what those stocks are. That's how I can make sure you don't have Microsoft in 5 places.
Is that going to give you the diversity of investment though? You buy that?
Sure. And it lets me pick what I want, right? So
think about within that group.
Think about the S&P 500.
Okay.
Right? I can buy the whole pie.
Right.
I can buy all 500 of them in one exchange traded fund, you know, and get it done. No manager, no internal trading cost, and I own that very, very, very cheaply. Now, we step it up a notch at the Financial Enhancement Group because we manage money, and so I'm able to look at the pieces of the S&P 500. So think about financials, healthcare, consumer discretionary, utilities. Those are pieces of the pie, right? So I can go in, like last year, we didn't want to own any energy. But after the Trump election, we certainly wanted to own financials.
Right, okay.
So I can buy XLF. That's a ticker symbol, right? It's an exchange-traded fund, and it represents all of the financial services companies that are inside of the S&P 500, but not the rest, just that.
Who wouldn't know that?
Anybody who manages money professionally. Sherry, you're under this delusion that you should be able to know all of this stuff, even though you know how much of my life I have devoted to it.
I know that.
So
I know that.
And that's what happened. The world has evolved.
Yeah.
And unless you're really in tune with this every day, you're going to miss things. And that's so. And I apologize because you are right. If you're confused about what an exchange traded fund is, then so is everybody else. So in a mutual fund, or I shouldn't say everybody else, but a lot of people, in a mutual fund, you put money in, I put money in, Barb puts money in. There is a manager that's inside of it. Now, if it's an open-ended fund, that manager decides what he's buying or selling.
But okay, so let me ask you this question, because I understand with the mutual fund, he's making that decision for everybody who's in that mutual fund. Yeah, like he makes a decision, it affects everybody.
He manages the money for a trust,
right?
And you own part of the trust,
right? So there's nothing specific personal about any decision he makes for me. Now, tell me the difference between that and exchange traded funds.
An exchange traded fund, they tell you exactly what it is you own. And then you decide whether that's right for you or not. In my case, I decide whether it's right for you or not.
Right, because I'm hired. Like if I hired you, you'd be doing that for me.
Right.
Okay.
So instead of paying a mutual fund manager who's never called you, has never looked at your tax return, doesn't talk to your attorney about your estate plan, you're paying a mutual fund manager, on average, the same amount of money that you pay us at the Financial Enhancement Group to do all the financial planning, and to sit down and manage the money.
Yeah.
Right.
And you can actually buy the same stock?
Yes.
Okay. Well, no, I'm just telling you.
Yes, we can.
You can buy if you want it, if I say I want the exact same stocks, you can do it.
So my contract at TD Ameritrade, I have 100 exchange traded funds that I can buy and sell for free. Zero cost to the families that we take care of.
Wow. Okay.
And $6.95 if I buy $1 million worth of stock or $100 worth of stock.
Wow.
Or sell it. So it's a pretty good contract.
I have one more quick question. Right. You said there were more indices than there are equities.
There are now, correct.
I don't know what that means. I don't know what.
So the S&P 500 is an index. By definition, it's unmanaged.
Okay.
So when most exchange traded funds are put together, somebody creates an indice. So
grouping, like you just said,
a grouping of stocks, or there's just tons of them, right? It can be the dogs of the Dow, the ones that have had the least performance last year. Right. It can be the ones that, that had the greatest performance. It's, all sorts of.
And who would know that? I mean, you see these little ticker things. Who would know that? I wouldn't know that if I'm watching these symbols go by. I'm not going to know what's in that thing.
No, you're not unless you're involved in the industry. The problem is we have made money and investing are far more complex than it appears.
Yeah.
And there is this belief that we're all supposed to be able to handle our own money. Some people come in and they're frustrated that they don't understand their tax return.
Right.
They're frustrated that they don't understand what's in an exchange traded fund.
Right.
And so some people bury their head in the sand
and say, I'm going to do it anyway.
And just throw money at it with what I call the hope strategy. They just hope it all works out.
Right.
And other people say, you know what, it's time. When I've got a minor burn or a blister on my toe, I can go to Walgreens and I almost said Hooks. That just shows you how old I am. I can go to Walgreens and figure out what it is that I need. Mm-hmm. When something's really wrong, I go to the doc. And the further we get in our lives, the more complex you will realize this stuff truly is. And it all goes back to the fiduciary focus in the very beginning. When I wake up in the morning, there are 4 things that drive me to take care of the families we take care of. And if you're listening to the show and you're working with a broker or you're doing it on your own, these are the 4 things that you better be paying attention to. Risk and volatility is obviously the ups and downs of the market. And what's the chance of me not getting my money back, right? Or what's the chance of me needing my money when the market's down? Risk and volatility is one. The second one are fees and expenses. And that's really what's always kept me out of the mutual fund industry. When I was able to look in and see that I owned the same stock in multiple places, that made no sense to me at all.
Right,
none.
No.
And secondly, the amount of trading costs that I saw that was taking place in the 90s was phenomenal. So inside of an exchange traded fund, nothing is ever sold unless I sell that ticker symbol, right? There is no, the mutual fund manager doesn't have to report to me what my 10 largest holdings were at the end of the quarter.
Right.
That's usually window dressing anyhow, because nothing changed, right? Nothing changed. It's static unless me as the money manager makes the change.
Okay.
So the reason we manage money internally at the Financial Enhancement Group, the reason I have a CFA and a chartered market technician is because I'm a tax junkie, right? Which takes you to the third part of the fiduciary focus. So you got risk and volatility, fees and expenses, taxes, both today and tomorrow. I want to make sure that when Adam buys or sells something, that it's bought or sold in the most tax efficient manner possible.
Right, yeah.
And there are times when we let our returns take a chance because I don't want something on your 1040.
Right.
Right.
Yeah.
We had a position that we bought that had a huge run up over the course of a year. We got very fortunate. That doesn't usually work out. We don't try to hit home runs.
Yeah.
Right.
Yeah.
But it just happened to happen,
Yeah.
So, but it was inside of the accounts, it was a short-term gain.
Right.
So inside of an IRA, we didn't care.
Right.
Because there's no tax.
Yes, exactly.
But at people who had accounts that were open to it, we waited another month and a half
and
to
you can
sell
do
the
that
position.
For individual.
Exactly.
Okay.
So we waited a month and a half to be able to get that done to make sure that it was in the right tax method for everybody that we take care of.
Okay.
Hey, folks, you ask really good questions, Sherry, and I appreciate it. And you guys ask good questions too. When you shoot me an email at considerthis@yourlifeafterwork.com, it really does help direct the show. It helps me understand what it is that you need to hear to better understand your money. And that truly is what drives me. Yes, it's the fiduciary focus, risk and volatility, fees and expenses, taxes today and tomorrow, and real return. That means you're not getting beat up by inflation. But it drives me insane that people as educated as Sherry don't fully understand their money. And that's our driving force to help you try to understand. We got to take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Good morning. Welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
We do have fun.
We do.
I don't.
We do.
It's a lot of interesting conversations on the breaks.
Yeah, but you assume people know things, and I don't think we all know it.
I spoke at a church on this past Sunday. I teach a lot in churches, and I guess financial pastor is the word, but I try to help people understand their money and do better things with charitable gifting and those kind of things. And it's always a great honor to talk at a church, but it was also a great honor to be able to be a professor at Purdue for 7 years, 14 semesters. And other than the wonderful students that I met and some that I ended up hiring, we've got a few that work here at the Financial Enhancement Group. The other part of it was having to start over 14 times.
Mm-hmm.
Is that it's not natural in your head to have to restart, because that those students don't know what the other ones just did that graduated, right? Mm-hmm. And there's a double curse of knowledge that exists inside of all of our lives. It's one, I don't know what I don't know.
True.
And believe me, there are things I don't know.
No.
But two, I don't know what you don't know.
Yeah.
And the longer I'm around not having to start over every time, the easier it is for me to presume that you understand what's going on.
Yeah.
And so we spend a lot of time in the backdrop making sure that the people that we work with and take care of really, truly do understand their money. And I do it through multiple mediums. So, we make sure that we start from scratch and work them to their level of comfort and understanding.
Makes sense.
An area that most people don't have comfort with is a thing called a required minimum distribution. Mm-hmm. And about once a quarter, I'll have somebody come into our office with $1 million inside of a 403B or a 401k and not know that they have to take money out at 70 and a half. Now that's what's called required. That means you have to, right? It's an Indiana terminology.
Right.
Have to. Right. Required minimum distribution, you have to take a mandatory amount of money out. It's a percentage amount, Sherry, based on your age and whether or not you're married. So if, let's say two people are married and we're within close enough proximity of age within 10 years, and we reach 70 and a half, I have to take out about 3.45% of the value of my IRA.
At that time.
Okay. Now, technically, it's the year after the year you turn 70 and a half. Okay. But if you wait for then, you have to take two distributions. Mm-hmm. So most people start at the age they turn 70 and a half. There's some reasons to delay it every now and then. But for most of us, most of our families take it at 70 and a half. And it's a percentage.
So in that percentage is a percentage of what's left, like
December 31st to the end of this year.
Right, but the next year it's the same
December
percentage.
31st of no. That percentage grows every year that you have to take out.
Okay, but the amount that it's percentage of is the new amount, not the
Correct.
original. So you're not going to run out of money because you're always just taking out a percentage.
Well, when you get into the late 90s and you're taking out 50%,
I know.
It's easier to.
Right, I get
technically, you don't get to zero. But it gets to be very painful, and we do have 80-year-olds with $1 million accounts that have to pull out 60, 70, 80 grand.
Jeez.
And it just, when you add your Social Security on top of it, many times they wind up being in a higher tax rate than they were before. But the question that I got asked, Joe, is how in the world can I reduce the taxes on the RMDs? Now, I have a favorite way. I have a second favorite way. I've got a third favorite way, and then there's a fourth favorite way. Right?
Oh, wow. Okay.
The first one is what I spoke at in the church this weekend. It's qualified charitable distributions. Mm-hmm. And that lets you, if you're over 70 and a half, lets you take your required minimum distribution up to $100,000 and give it directly to a charity. You can't touch it. It's got to go to the general fund.
Okay.
But you can have it sent directly to the 501c3. Mm-hmm. So your church, a university, you can take that and put it in. You do not get a deduction, but you do not have to pay the tax either.
Okay.
So, In many cases, and in most cases, if I can pull something off of page 1, what we would call above the line, it's better for you than a deduction below the line. The line's your AGI. And most of the time, removing income is better than adding a deduction, right? So this works out very well for people. And what I'll have happen is I'll have somebody, it happens every year, somebody will come in and they give 50 grand a year away to charities. And they've got a stock portfolio where they weren't giving appreciated stock because the broker never told them to. The CPA never told them to because the CPA sees that after the fact, you've already made the gift.
Right? Yeah.
And that's why tax planning, not tax reporting. Tax reporting's done in April. Tax planning has to be done right now. It has to be done this year, right? But you can use that required minimum distribution in a qualified charitable distribution. It's now permanent part of the tax code. That's one way to do it. My second favorite way to do it is if you happen to be over 70 and still working, and you don't own more than 5% of the company stock, if your plan allows for it, you can actually roll your IRA into the 401k. That makes it so that you don't have to take a distribution until you then retire. It gives you a delay. That doesn't work with IRAs. It does work with a 401k if you happen to still be working. The third way is what's called a QLAC, Qualified Longevity Annuity Contract. And what it essentially lets you do is take up to 25% or $125,000, whichever's greater, or whichever's less, I should say. You're able to take it and put it into an annuity contract that doesn't start until age 85, typically. Wow. So what that does for you, Sherry, is make sure that you're not going to live out your income, or outlive your income. That's one. Two, it makes it so that you do not have to take a required minimum distribution on that block of money that you transfer.
Okay, so you said usually till age 85?
That's when it kicks in. That's when the income from it starts to kick in.
What if you don't live to be 85?
Then your family gets back the money.
Okay.
Yeah, it's not lost.
Okay.
Great question. It's not lost, but it's another way to reduce that RMD at the earlier stages. Then my absolute favorite, anybody who knows me, is using the Roth conversion. I think it's a very missed part of the tax code that most people will tell you that a Roth conversion is a tax decision. And I will tell you that it does not originate that way if you understand it correctly and understand the loopholes. It is first a cash flow decision. Do you have the cash to be able to pay the taxes if you so choose? Number two, do you invest in equities? And if the answer is yes, then the Roth conversion makes sense for you. I don't care what anybody else tells you. The Roth conversion makes sense for you if you already invest in equities. And then, because of a hole that's in the tax code, we're able to look at it from a return perspective. How did the investment do? And the tax code to see where your marginal tax rate would be. And I'm able to say, hey, if you had this return, would you want to pay, if you want to pay taxes, this is what it's going to cost. And here's how much money stays in a Roth forever.
Yeah.
And if the return wasn't good enough, we send it back through a hole that was left in the code in 1997. People ask me every year, they fix it yet? They fix it yet?
Yeah.
And nope, the hole is still there, and I think it will continue to remain there.
Wow.
But Roth conversions are a great way to go. I had somebody tell me at 75 they had no business doing a Roth conversion. It's kind of like I've done Roth conversions for 86-year-olds. There's no part of that is age restricted or income restricted. The AGI rule is off.
Yeah.
Right. It's really that three-step process. One, do you have the cash to pay the taxes if you want to? In other words, if all of your money's in a 401k, this may not make sense.
Right.
Two, do you invest in equities? If you invest in just cash and CDs and bonds, this makes no sense.
Right.
For the purposes that I'm talking about. And then number three is do you to be able to sit down that next year and make a tax determination and a return determination as to whether or not if you put in $50,000 and it's now worth $70,000. Is it worth paying taxes on 50 to have 70 tax-free and RMD-free forever?
Forever,
And
wow.
if the answer is yes, we pay the taxes. If it's not, we send them back and we start over.
Wow.
Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. Lots of stuff that I would like to talk about, even more things that I would like to show you. Shoot me an email or give us a call, 800-928-4001. We'll take a break and be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning, and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Got to tell you a funny story, since Sherry and I were talking about this at the break. You know, my youngest daughter, Kendra, is in nursing school at Anderson University. And this young man is in her Bible study group with the church, and is going to work at an insurance company. And his card clearly says financial planner. And Kendra and him started talking, and he said he does exactly what your dad does. And Kendra goes, she was mad. You can understand when Kendra gets irritable, bad things can happen, right? And so she called and she goes, Dad, I don't get it. He's able to call himself exactly what you are. And I go, Kendra, as much as I hate to say it, it's not like nursing. You can call yourself a nurse if you're a nurse, right? And you can't call yourself an RN if you're an LPN, right? There are rules. You can't call yourself a doctor if you're not a doctor. There are rules, for goodness sakes. The bad news is anybody can call themselves a financial planner. Any of you listening to this show can go out today and put financial planner on your card, and there's no regulatory body to protect you, worse yet, to protect the people that you're going to talk to. Now, what he can't say is that he's a certified financial planner. I've been board certified, I'm continuing ed, and all of the other stuff, and the disciplinary board.
Right.
He can't say that he's a certified financial planner, but he can most certainly say that he is a financial planner. Just word to the wise. It doesn't mean any licensing. It doesn't mean they know anything. It's just a title that people throw around and use. One of the common questions that I get, especially from new people, and I would say people in the 40 to 50 year age range more so than any other group, but it goes something like this. How am I doing?
Yeah.
Right? How am I doing? And
technical question.
I've done this long enough to know that it generally means how am I doing relative to other people in my age and income group. And I guess it's a worthwhile question if it makes you happy, but that's not what we really talk about inside of the Financial Enhancement Group. That's not the basics. What I know about math is, and there's a book behind me on the bookshelf, and it's. I'm going to change the word just because, but you can figure it out. It's called Lies, Darned Lies, and Statistics. And you can figure out which word I substituted. And what it essentially says is you can tell any story you want to with math if you can control the variables, right? So here's a good one. If I put $10,000 into large capitalization U.S. stocks in January of 1926, how much do you suppose I would have today, Sherry? $10,000,
Yes.
90 years.
Since 1926?
1926, 90 years.
A lot.
60,351,000.
Oh, my gosh.
And some change.
Wow.
Had an average annual return of 10.04%. Okay?
Seriously?
60 million. That's a lot of money. That's a lot of dinero.
That's
right?
a whole lot. Why did we? Well, I wasn't around.
Now, the problem is the average mutual fund investor over the last 20 years, according to Dalbar, has averaged a little over 4.6%. Right? 10% for the S&P 500, which wasn't even the S&P 500 at that point in time, right. Mind you. It's what it says, large capitalization stocks. 10% for this thing that you couldn't even buy.
Right.
Or 4.6.7 is what the average person actually pulled out.
Wow.
Right? Now,
big difference.
The way they use that then is to make you feel bad. So here's a couple things I want to help you out understanding. This is your journey. It's not your broker's journey. It's not the indices journey. This is your journey that you're on. And it is a journey, my friends. It's not one quarterly statement. It's not 1 year. It's not even one decade, right? We've got people that have been in families that we've taken care of since I started in the industry 29 years ago, right? And the firm's 20 years old this year. So we got a bunch of them that have been around since that long. First question is, why 1926?
Yes, why?
What was wrong with 1925?
Yeah.
Yeah. So the answer is they didn't keep the closing price of individual equities until November of 1925. You have to go back in the history books, dig them out to reassemble.
Okay.
So everything was started in 1926. So everybody goes back to that. If you'd gone back and you'd looked at and started in 1923 or 24, the returns would have been dramatically different.
Seriously?
Right? Yes, seriously. That's one thing to consider. The second thing to consider, especially for those of you that are accumulating money, right? It doesn't matter what the return was in a period of time that you weren't alive in. Right?
Exactly.
So in this magical world, we dumped in 10 grand in 1926. I am 50, not 90, and I sure didn't have 10 grand in 1926 to put it in.
Yeah.
So Wade Pfau, one of the professors at the American College, one of the places that teaches CFPville like I did, did this interesting math, and he said, if he started in 1995, when he really started working, and he was able to dump the 10 grand in all at one time, he would have had $75,423 at the end of the period of time. But the challenge is he didn't have $10,000 in 1990. He had to put money in every single year. And so instead of having 75, he would have, in theory, had $26,000 or $27,000.
Which doesn't sound like that much money.
It doesn't sound like that much, but the point is, and it's one of the things that we talk about, is sequencing risk. So when you're going through that flight, right? I talk about the 3 phases of finance. In accumulation, right? It doesn't matter so much as what your return is each year, is that you're putting in money each year, right?
Right.
Because the market's going to go up and down, and actually it doesn't hurt you at all if the market is down because you're buying on the cheap, right? I've been in this industry for 29 years. There have been a lot of volatility in my career, 87, 91, the tech wreck, 9/11, 2002, 2008, and the market's still at all-time highs, right?
Yeah.
I mean, it has volatility along the way, right? Yes. But in accumulation, when you're getting on that airplane, when you say, hey, it's time to get into this, your first goal, your objective is to save the right percentage of your income, and then it's to pay attention to the most destructive part of any retirement plan I know, and that's called the Internal Revenue Service. The IRS will separate you from your retirement.
Money. Yep.
Right? So your second thing in accumulation when you're first getting on is to make sure that you're building tax diversification. That means you've got some money that's tax-free, some money that's exposed to the taxes, and some money that's tax-deferred. Eventually, what you are saving is not as important as what you've already saved. I liken that to being at 30,000 feet in the sky. Right?
Okay.
When you're there, the only thing that matters is average return. But, Sherry, here's the big but. And this is the only time that average return matters.
When you're in, you have the money.
You've already got a lump. You've already got a bunch of money put up.
Okay.
I've got a lot of people that retire and then don't touch their money for 10 years.
Yes.
Right? Except for Roth conversions and other things we do. But average return only matters if you're there beginning, middle, and end. And, we've talked about Peter Lynch before with a 20-year track record of 25% a year.
Yeah.
Right? And half of his investors lost money, according to him, or over half. Average only matters if you're there beginning, middle, and end. But when you go to land that plane in distribution, when you're trying to actually pull your money out, it's a driving force of what we do here at the Financial Enhancement Group. When you're pulling that money out, it's the volatility, which is why the management is so critical, right? And secondly, it's the tax rate you pay on the average dollar you use. And when you can effectively control those two things, then you can get to where it is that you're going. Return does matter. Don't let anybody tell you that return doesn't matter. But it's not the only thing that matters, right? It's risk and volatility, fees and expenses, taxes today and tomorrow, because you are on a journey, and making sure that you get a real return. And if you can put those together, good things can happen. Hey, folks, my friends that are on WIBC with us today, you're done. That was our fourth segment. Don't forget, you can go to our website at yourlifeafterwork.com to get the fifth and final segment. For the rest of you, Sherry and I will take a break and be right back. Email me, consider this, at yourlifeafterwork.com.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana, with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
It's Sherry's favorite 9 minutes of life.
I know. Well, this one's a little different. It's more philosophical than I normally get. Do you really?
If you're new to the show, by the way, Sherry's our guest host. She's what we call the average Joe. So she keeps me straight and makes sure that I try to use verbiage that everybody understands and make sure that you're getting value out of the show. That's the goal.
Yep.
But she always brings something that I don't know anything about. I shouldn't say that. It's something I haven't seen, so I don't know what she wants to talk about.
Yeah, I haven't found something yet that you don't know anything about, but you don't know what's coming. So, okay, so here's I'm going to start with this question. What is your favorite Starbucks coffee drink?
I don't go to Starbucks.
Oh, shoot.
I will, and it's not that I'm against Howard or anybody else. I quit drinking coffee for a year, and I just recently restarted. I don't like lines. Right. So every now and then I will go to a Starbucks to meet somebody. Right. And if I have to get something, it's going to be a really plain vanilla large black coffee. I don't put anything in it at all.
That was going to be my question. If you're a plain coffee person or if you're like a venti ice skinny hazelnut macchiato with sugar-free syrup kind of guy.
No, that would not. No.
Okay.
I'm a pretty much keep it simple, straight kind of guy.
Okay. So the reason I asked the question is this. I ran across an article from a financial planner who said that he had two basic questions he asked everybody that came in their office. Everybody that he talked to about financial planning. Okay. Two basic questions to start with. And from those two questions, he could begin to start helping them plan their financial future. And the very first one was, what is your favorite Starbucks drink? Now, why do you think he would ask that question?
To find out if people like a lot of complexity and fluff in their life, or if they really want to get down to the nitty gritty, would be my guess.
Well, he said he asked it to see if they need to, how their budgeting is, and if they need to scale back, if they like to live large, in other words, or not.
So that is a philosophical question, because we used to have a young man who was here who was a CFP, and I used to have to tell my Purdue students, you guys are probably more financially disciplined than your friends that you run around with at Purdue, hence being in a financial class, right?
Yes.
And he would sit down with you at your age and want to go over a budget with you, and I will have nothing to do with making budgets.
Right, yeah.
It is not my job to tell you whether you spend too much money at Starbucks or not. Now, when people prepare for their retirement practice year, I want to know how much money you need monthly and how much of it is for social stuff that will go down over time, and how much of it's fixed that will probably go up in cost because of inflation.
So
that's as far as I go to the budget.
That's kind of your Starbucks question then. You're asking, when you ask that question, you're asking because you want to know how they live now.
Yeah. I live in the same house that I bought in 1998. I've got a 2009 car. But I like really good food. And so I will spend money at restaurants that some people would say is just obnoxious, because I like it, right? But I won't spend $80,000 to buy a new Suburban. I would rather, go down the road in my old one.
See, that's my thought when I read this, first of all, was I would never buy a skinny iced macchiato, hazelnut, blah, 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 blah. I'm more of a plain coffee person, but I do like things like clothes. Yeah. I mean, I will do things, shoes.
Purses.
Okay. But so I think everybody's that way. Sure. So I'm not sure that that's an accurate way to assess.
But a lot of, in CFPville, when we are taught to help people with their budgets, and it's an important thing, it's just not my thing. Right, there are people that don't understand if you save the $2 a day or the $3 a day on the coffee, what that can compound to over 40 years.
Right.
And those are important stories. They ought to be taught in junior high and high school. You shouldn't have to tell a 30-year-old professional that. But we are taught as CFPs how to go through that conversation. I just don't.
Right. So your philosophy would be more like, I want to help you do what you want to do.
I want to help you make the most with what you have.
Right.
Right. And I, when you've done this for 3 decades, right? I have the 90-year-olds with a whole lot of money and not a lot of life left.
Right.
And so yes, I get paid to manage money. That's my job.
Right.
But we do our best to help people have a life. And, do you need to have 3 Starbucks every single day of your life? Probably not.
Right.
But, I'm not going to tell somebody who's 55 years old, who's worked hard, that they shouldn't be at Starbucks. Now, There's a lot of kids at Purdue, I'd like to explain, that their mommy and daddy shouldn't be buying them Starbucks every day.
Exactly.
And I this is a soapbox thing, so let me just do it real quick, guys.
Okay.
Here's the thing. When you go to retire, I will tell you as many times as I possibly can, my job is not to replace your income. It is to replace your standard of living.
Which is why you don't ask that question.
That's one of the reasons. It's to replace your standard of living. Now, hear me straight on this with these kids, because I spent 7 years at Purdue, right? You're setting them up where they cannot replace the standard of living to which they have become accustomed.
Exactly.
Right? And that never leads to good stuff. I tell people in here, it leads to anger management.
Yeah.
Right? I mean, you've got to be able to replace your standard of living or keep working, because it's emotionally, people just don't want to take a step back.
Yeah.
And that's, it's a challenging thing. Anyhow, end of soapbox.
Okay. Well, okay. So the second point that this financial planner asks, and I know you asked this, is your financial goals for the future, which I think would tie into your 90-year-olds that have a lot of money. They could have still lots of financial goals in terms of gifting or things. And so go ahead.
We do it a little bit differently.
Okay.
When somebody has a financial goal, when I hear that, it's usually I want $1 million, or, I don't care.
Right, exactly.
We ask a qualitative statement we call the financial vision.
Right.
And it's 2 sentences where I want to know where you're wanting to go. Right. So
where you're wanting to go.
One of my missionaries, his financial vision is at 65. He wants to give away more every year than he spends on himself.
Okay.
Right.
Makes sense.
So I know to set stuff up so that it's the best way to give from a charitable standpoint, from a tax standpoint, the best way to be able to give. Yeah. I know how much income he needs to be able to get that done for him to maintain his standard of living and make those gifts. So I was able to tell him how much he needed to save. I've got another doc, and his wife, his message is very clear. At 92, she doesn't want to be a bag lady.
Sure.
And
I think most people would say that.
That means make sure that we don't run out, right?
Right.
And so, tell me if I'm doing something that's incorrect or
right.
wrong along the way. But that financial vision helps there's 25 people in the financial enhancement group now, and it lets my paraplanners, it lets my other planners all stay focused on that same mission. So whether you're seeing me or whether you're seeing Aaron or Grant or Dean or Sarah, the financial vision is there in front of them. It goes, okay, this is consistent with your financial vision.
Yeah.
And
I think that's
and
important.
it gives us that direction to make sure that we all stay on the same page. As we age, sometimes we do things we didn't intend to do.
Yeah.
And when I'm able to put your own words back in front of you,
I think that's brilliant.
It's helped keep people on track in terms of where they're going. And honestly, a lot of people have never thought about a financial vision.
Sure.
Most people are really throwing stuff at it, hoping it's going to work. I ask people all the time, why did you put $24,000 in your 401k? Well, that's because that's all I was allowed. Okay. What if it's not enough? What if it's too much? What if you're oversaving and you're not enjoying life enough now?
Right. Yeah.
But what if it's not enough? I mean, so many times we get caught doing things because this is what the company said we could do or what the IRS said we can do. I would challenge you to make sure that it's matching your objectives, your financial vision, your direction. Good subject, and not that philosophical, I don't think. I think it's a very worthwhile thing. If you're going to work with somebody, they should understand where you're trying to go.
Right.
And saying that, I can't tell you whether you need $1 million or $1.5 million without knowing what the inflation rate and the future tax rate are. All I can do is say, this is the direction that we're going, right? And here's how we want to set it up so you have the best opportunity for success.
Yeah.
Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We got to take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Very, very happy to have you along.
We are.
Folks, your questions really do drive the show. And I do my best to make sure that I remember to start over when I can, right?
Yeah.
It is, 29 years of doing this, 20 years of doing the radio. Of talking about this, 7 years of teaching it. There's some of this stuff that is just so ingrained in my head that it's not natural for me to remember that people don't know it, right? And Sherry, you do a good job of trying to extract that out of me, and that is important. But it's also why we build checklists. And I love reading books. I did not know much about the story of Nike and Phil Knight, but if you have time. Shoe Dog is a good book. There were some good business things that are in there. The Outsiders is another book that I'm reading, but I'm going to give you one of my favorite, and it's how our company, to a large degree, is built, and it's called the Checklist Manifesto. And essentially, the concept is this: don't start over if you don't have to. All right? So, over the 29 years, I've taken care of more than 1,000 families. We have about 670 some families that we take care of right now. People do pass away,
Sure.
just it happens. But when we have a situation that may be unique in a person's life, I had to bury my father. As a human, I will only do that once.
Right.
As a managing partner of a financial planning firm, I've done it 100 times. Right.
Yeah.
So why start over?
Right.
If if you've lost a spouse, here's the checklist. Here are the things that we need to do internally. Here are the things that you need to do as the spouse and be aware of. Here's the things the kids need to be able to pay attention to. And why not just add on to that? And that's really what Checklist Manifesto made me understand. It's what surgeons do inside of an emergency room or inside of a normal surgical procedure. Just even though it may seem basic, it's easy to skip basic steps if you don't have that checklist in play. And I know we get paid to manage money. But I spend about 70% of my time doing things that I don't get paid for. And that may sound crazy, but I believe in those 5 critical elements, right? Your life after work, tax planning that has to be done before the end of the year, the investment playbook, which is how we get paid, the life happens, the things that go on in your life financially, and the legacy plan. We don't get paid for any of that other part. But all of those matter. And if you don't have somebody looking out for you, it might be worth giving us a call at 800-928-4001. Folks, we wish you a very, very happy June. I hope you enjoy the rest of this great year. Look forward to hearing from you and seeing you soon. Consider this at yourlifeafterwork.com. Take care.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a great week.